Hello and welcome to today's bootcamp for ethics and professional practice. Of course, this is the common law bootcamp. My name is Sam Albanese and I'm going to be the instructor for you this evening. The ethics exam, of course, is 75 minutes long, as you know, and is only 20 questions. Traditionally, you've been used to doing 30 questions, but the ethics exam is actually only 20 questions, and you still have 75 minutes. Now, as we go along all this, of course, if you have any questions, I'll be happy to answer them to the best of my abilities. And obviously, at any time, you can always email us. Just go to your website, get the email address from there, and you can send emails to me, and I'll be more than happy to answer them, usually within 24 to 48 hours. Okay. So the traditional way that we've been doing all of this, of course, is we ask the question. I ask you to take a moment to read it. Then I will, of course, summarize the question and go over the answers for you. And in the process of doing that, of course, we will also not only give you the answers, but also tell you why the other ones are not correct. I will also give you the reference in the book, the ethics book, so that you can go back to the reference to the book. You can see for yourself how all this sort of unfolds. So let's get ourselves started. And the first question is, we've got Greg. So once again, I'm just going to give you a few moments to read this at your leisure, and then I will summarize it for you. So what we've got is Greg. He owns an immediate life annuity contract, and he's named his wife Rita as the annuitant and the annuitant grantee. In other words, as the annuitant, she also gets the money whenever the annuity is due. Basically, she also gets the money. So not only is she an annuitant, she's also the person who gets the money. So the annuity pays $500 per month and came with a guarantee period of 10 years. So we've got a 10-year period of guarantee. Greg had named his daughter Sally as the beneficiary. Rita died 12 years after the annuity commenced payments. In other words, his wife died after 12 years. So who will receive the benefit of the annuity contract? Now, before I answer that, just remember that when we're talking about an immediate annuity with a guarantee period, in order for a beneficiary to receive any funds, basically the annuitant has to die within the guarantee period. So if Rita had died within that 10 years, then yes, the beneficiary would have received the monies and everything else. Okay, but because she died after the 10 years, obviously the answer is there is no benefit to be paid out as the guarantee period is lapsed. So the key element here is whenever you have a guarantee period, you must die within that guarantee period. So in this case here, we have a 10-year guarantee. So if Rita died, let's say in the 5 years, then for the next 5 years, the beneficiary Sally here would have received $500 per month for the balance of those 5 years. Okay, but in this case here, unfortunately, or fortunately, depending on how you look at it, Rita died after the guarantee period, so therefore the benefit simply stops. Okay, and that is the key element of a guaranteed annuity with a guarantee period. That is discussed quite extensively, actually, on Chapter 3, so in Section 3.8. Chapter 3, Section 3.8 talks all about the immediate annuities and the guarantee period. So I strongly urge that you read that, because there usually is a question on the exam on the guarantee periods. So now let's go on to number 2 and give you again a moment to read this here. We've got Julius here. Okay. So Julius has created an enduring power of attorney document in which he states that his cousin Andre will be appointed as his attorney to deal with all his properties in the event that he becomes mentally incapable. So again, I draw your attention to the word enduring power of attorney, because as you know, in a power of attorney for property, basically you've got two kinds of power of attorney. You have what's called the limited power of attorney, which sets out the documents basically for a limited period of time. It could be a few months, it could be a year, and that is what they call limited power of attorney. An enduring power of attorney, on the other hand, ends basically when the person actually dies. And then, of course, the will takes over from that. That's why they call it enduring. So So this enduring power of attorney basically says that when Julius becomes incapable, mentally incapable of handling his own affairs, the power of attorney doesn't stop. It continues on. So it continues on really until actually, in this case here, Julius actually dies. So the question now comes into a question of what can he not do? So which of these actions cannot be taken on behalf of Julius by Andre as his power of attorney? And the answer is change the beneficiary of Julius' life insurance policy. In actual fact, there are two things that cannot be done by the power of attorney. Okay? The one statement right there, you cannot name yourself as a beneficiary. In other words, you cannot change the beneficiary in Julius' life insurance policy. When you think about it, that makes plain sense, because obviously if he had the power to change beneficiaries, then obviously he would name himself as a beneficiary. So that would be a clear conflict of interest in that he would basically name himself as the recipient of the insurance policies and everything else. So, as I said, it would be a clear case of a conflict of interest. The other thing, which is not on there, but you should be aware of for exam purposes, is he cannot do a will on behalf of Julius. Okay, so in other words, Andre cannot do Julius's will. Because once again, if you think about it, if he had the power to make a will, then obviously he's going to name himself as the beneficiary of Julius' estate. So both in changing beneficiary designation as well as doing a will, you get yourself in direct conflict of interest, and the law simply does not permit that kind of a thing there. And so therefore, the insurance company who receives that change of beneficiary, whatever, or the estate with the will and everything else will contest that, and basically the court will just simply throw that out because there is a direct conflict of interest. So two things for exam purposes. You must remember that a power of attorney cannot do. He cannot make a will on behalf of the grantor, in this case Julius, and cannot change the beneficiary in the Julius' insurance policy. Okay, so let's go on to number 3. And we've got Daisy. Again, I'll give you a moment to read this. So here we've got Daisy, a new life agent, and wants to know which of the following does not, again the word not, remember it's very important, does not need to be met for a policy to come into force. What do you tell Daisy? So basically what you can tell Daisy is the thing that does not have to be done is name a beneficiary of the policy. In other words, for a policy to actually come into force, you don't have to have a beneficiary. Obviously we recommend that you do have a beneficiary for obvious reasons, but it's not a prerequisite in order for a policy to come into force. So in the event that there is no beneficiary named, the person should die, then the money simply gets paid to the estate. So ultimately, at the end of the day, the default, you might say, the default beneficiary is always your estate. But so therefore, naming a beneficiary is not a condition of a policy coming into force. Whereas the other 3 items, of course, the acceptance of the application by the insurer, is definitely obviously the insurance company has to accept the application for obvious reasons. The client, of course, has to accept the policy when it's delivered. Okay, so when the policy is actually delivered back to the client has to accept that contract as well. And of course, obviously, the first premium must be paid, whether that premium is a monthly premium or an annual premium, doesn't matter. But at the very least, you have to have 1 month's premium. So the one thing that you do not need to do in regards to putting a policy in force is the name of the beneficiary. So you do have to have acceptance by the insurance company. You have to have insurability. All of those things there, of course, have to be all part of the application process, the acceptance of the application process. But naming a beneficiary is not one of those things, and that is discussed quite extensively in Chapter 2 of the ethics book, and in Section 2.1. I'm not sure if I mentioned the previous question, question 2, the question of the power of attorney, where you get that information from. That is on Chapter 1. Chapter 1 in Section 2.4 talks about the power of attorney for limited power of attorney and the enduring power of attorney. So for question 2, it's Chapter 1, Section 2.4. For question 3, it is Chapter 2, Section 2.1. If you want to know more about what is required for a policy to actually come into force. So let's go to number 4 now, and we've got Carlton. years ago, Carlton purchased a life insurance policy at $500,000 from Protected Life Insurance Company. Yesterday, the Protected Life Insurance Company filed for bankruptcy. So obviously he calls the insurance agent who represented him in the purchase of the policy and wants to know what is going to become of this policy. What does Carlton insurance agent tell him? Now, this is obviously a case of Assuris. Okay, this is a situation where, as you know, with the insurance companies all contribute money to Assuris. So Assuris is a consumer protection agency that will protect the consumer in the event of a default. And if you remember, with Assuris, we made it clear that it's 85% of the covered benefit, no less than a specific amount, basically. So, in other words, Assuris will assure 85% of whatever you're entitled to. So in this case here, it's $500,000 is the full amount. So, but not obviously because of the bankruptcy, you're not going to get the full amount, but at the very least, you're going to get 85%. So if you do 85% of $500,000, you'll see there that it's $425,000 is the minimum amount, absolute minimum amount. Okay? So remember that Assuris, of course, provides protection for disability insurance, for example, 85%. Anything that pays on a monthly basis, be it an annuity, be it disability insurance, anything that pays a monthly benefit, it's 85% of the covered benefit, no less than $2,000. In this case here, of course, strictly a life insurance, so it's 85% of the covered benefit, no less than $200,000. So please review this very important because on the exam, they usually will have at least one question on the Assuris situation. Okay, so Assuris is very well discussed actually in Chapter 4 of the ethics book, and it's in section 1.4 is where that particular section is covered. So I urge you to read that section very carefully. So again, Chapter 4, section 1.4 talks about the Assuris and all the things that they cover and things of that nature. Because remember, there's a whole list of different products. So depending on the type of product, we'll have different minimums and everything. So in this case here, it was a life insurance, and the minimum was $200,000, but it's 85% of $500,000, so it's $425,000. It's an absolute worst case scenario that they will get in the event of a company failure. Let's go to 5, and we've got Tim. So Tim would like to know, are there maximum and minimum limits to withdrawals that can be made from accounts that he owns? You tell him that there are statutory minimums that must be withdrawn from registered retirement income funds, RIFs, or a life income fund, or LIF. You also tell him that there's a maximum amount that can be withdrawn from which of the following accounts. So before I answer the question, just remember that there are statutory conditions in terms of the minimum amount of money that it must take out from a RIF and from a LIF. And these are statutory in the sense that the province themselves, wherever you happen to be in the province in Canada, your province has a table. Okay, usually it follows the federal government's guidelines, but it has a table. So it doesn't really matter where your money is invested, which institution or which insurance company holds your money. The table is standard for everybody. So everybody, regardless of the institution, must abide by the tables that are given to them by the province that you happen to be in. So in this case here, the answer is a LIF. A LIF has a minimum amount, which is, like I said, is a statutory amount, but it also has a maximum. So you cannot take out more than the maximum amount. So if you look at the word life income fund, another name for that, of course, locked-in income fund, basically. And so what it's designed to do is to give you an income for the rest of your life. And that's why they have the maximum. See, the RRSP, if you wish to take out a cancel the RRSP, you can cancel anytime you want. There's no limit to how much money you can take out from your RRSP. There is no limit to how much you can take out from a RIF. A RIF has a minimum amount, okay, but it has no maximum. So the minimum, again, is statutory, and therefore you must take out a certain amount of money every single month, basically every single year, whatever. That's the absolute minimum you can take out. However, there is no maximum. So once again, if you take out too much money, it's quite possible you might run out of money. The TFSA, of course, again, there's no minimum, no maximum. You take the entire amount, whatever you need from the TFSA. So in the TFSA, like an RSP, there's no real minimum or maximum. You can simply cash the whole thing in, and that's it. Okay? But a life income fund is designed to give you an income for the rest of your life. So while we require you to take out the minimum, we also say to you, you're going to take out more than the maximum. So the idea, of course, is to make sure you have an income for the rest of your life. That's the and so if they don't have that maximum, quite possibly you can abuse the system, take out more money, and before you know it, you're 85 years old or something, and you just run out of money. Okay, so you can run out of money out of your RIF, for example. You can run out of money from your TFSA, but the idea is not to run out of money from your life income fund. Okay? And that is discussed in Chapter 2, in Section 2.7. Talks about these particular products and what you can do in terms of minimum and maximums and all that sort of stuff. So Chapter 2, Section 2.7 will give you more information about what we just reviewed. So let's go to question number 6, and we've got Nellie. Okay, so we've got is Nellie, and she purchased a life insurance policy on her son Adam's life for $300,000. Same time, she named Danny, her spouse, her husband, basically, as Adam's father to be successor of the policyholder. So this is a third-party policy, obviously, where Nellie owns a policy on her son. And in the event that something should happen to Nellie, basically what he says is, oh, I'm going to make your father as the successor owner, the successor policyholder, another name, contingent policyholder. And if you remember, when we discussed this earlier, is that if you have a third-party policy, you should always have a successor owner, because what you don't want is the money to go to the estate, basically. Okay, but let's move on. So she also named Adam's sister Sally as the beneficiary of the policy. So when Adam reached the age of majority 1 month ago, Nellie, of course the mother, gifted the policy to Adam by making an absolute assignment of the policy to him. Unfortunately, Adam did not do anything about the policy and died in a boating accident. And so therefore, who will receive the payout of $300,000? When you have a change, when you assign a policy on an absolute basis, okay, the beneficiary, the previous beneficiary, is null and void, because the new beneficiary will have to be named, of course, by the new owner. So in this case here, when the policy was transferred over from Nellie to her son Adam in absolute assignment, then the beneficiary, which was of course the sister in this case here, Adam's sister Sally, would be null and void. It would not be honored. Adam needed to name a beneficiary, but unfortunately Adam didn't do anything about it. Then he died. So really, what we've got here is that the money now, there's no beneficiary here now, because that beneficiary is null and void, and therefore the only place that we can actually pay any monies, because in the lack of a beneficiary, then it will go to the owner's estate. In this case here, Adam is the owner of the policy, and therefore the money will be paid to Adam's estate. So always remember that if there is no beneficiary, it will go to the insured or the owner's estate. So if Adam in fact had changed beneficiary, then obviously it would have been paid out to the beneficiary. He could have very easily kept Sally as the beneficiary if that's what he wanted to do. But in this case here, he did absolutely nothing. So the act of actually transferring the policy on an absolute basis nullifies the existing beneficiary destination, and a new beneficiary needs to be named. In this case, however, he did not do that, and so therefore the insurance company had no choice but to make the money payable to Adam's estate. This is discussed in Chapter 3. Okay, Chapter 3, Section 2.1 will give you information about the successor owners, contingent owners, things of that nature, third-party policies, things of that nature there. So Chapter 3, Section 2.1 should give you all the information that you need to answer that kind of a question. Let's go on to number 7, and we've got John. Okay, so we got John as a term life insurance policy in his own life. The policy terminated by the insurer for non-payment of premiums after 30-day grace period. His agent informed him that the cancellation is not final since the insurer is obligated to reinstate the policy. Which of the following conditions does John not need to meet in order to reinstate the policy? Not need to meet. And so basically, he does not have to provide any justification for missing the premium payments. Okay, in other words, he doesn't have to turn around and provide an excuse of some kind as to why he missed the payments. However, he does have to apply for reinstatement within the 2 years of cancellation. So within 2 years, you have to apply for a reinstatement. After 2 years, it becomes a brand new policy. So if you want to reinstate the policy, you must do it within 2 years of the policy actually lapsing. You must also pay the unpaid premiums. You must, in other words, all the money. So let's say that you had $100 a month, for example, and you lapsed it, and then 12 months later you decide to reinstate. Well, then you're going to have to pay back that $1,200 that you did not pay for that 12 months, basically, as well as interest, what they call the opportunity cost, will also have to be paid. But most importantly is you also have to prove medical insurability. In other words, you have to give us satisfactory that you are in fact insurable. And so therefore you may be subjected to a medical, you may be subjected to an APS, or sometimes it could be simply as a medical declaration basically issued by the insurance company itself. The point is you have to provide medical insurability. And so in a sense you might say you're also sort of almost starting again, because when you reinstate the policy, the suicide clause starts again, the disability clause starts all over again. So the obvious question sometimes when I talk about the subject in class, they say, well, why doesn't he just buy a new policy? If he has to go through all this stuff, just buy a brand new policy. And that's a very legitimate question. And the answer really is that yes, he can certainly do that if he wishes to do that. The problem is that when you reinstate at an older age, you're going to obviously, you start a new policy rather than older age, you're going to have to pay the older age price. So if you reinstate the policy, you maintain your current age at the age that you originally started. So if, for example, you bought a policy at age 30 and you lapsed it when you were 40 and you reinstated at age 41, then you're still going to be paying the age 30 rates. If you started a brand new policy and you were 41, well then you'd have to start at age 41, which would be obviously considerably more expensive. So one of the reasons why people reinstate is to maintain the old age. So the things you must do in order to reinstate is apply within 2 years, pay back premiums along with the interest, and provide proof of insurability, basically. You certainly do not have to justify as to why the policy was lapsed or anything. And that is, the reinstatement is Chapter 2, and it's Section 4.3. So Chapter 2, Section 4.3 will give you a good description of what we just talked about. And let's go on to 8. And we've got Ron. Again, I'll give you a moment to read this. So we got Ron owns a life insurance policy on his life and has named his wife Rita as the irrevocable beneficiary of destination. So the word irrevocable, of course, is very important here. Irrevocable beneficiary policy. He understands that he has to get written consent for Rita to make major changes to the policy. However, Ron does not need Rita's written consent to do what? Okay. So remember that when you name somebody irrevocable, you pretty well tie up your hands, and that almost everything that you do has to be approved by the irrevocable beneficiary. But in this case here, the thing you do not have to do is you don't have to get Rita's approval in order to change the premium payment schedule from annual to monthly. So that's okay. As long as the premiums are being paid, it doesn't matter whether it's monthly, semi-annual, whatever. So you don't have to get approval from the irrevocable beneficiary to change the method of payment, so to speak. But you do need to get permission if you're going to withdraw cash from the policy, because that obviously affects the value of the policy. If you're going to assign the policy collateral, absolutely, or whatever, an absolute assignment or collateral assignment, once again, you're going to have to prove, you're going to have to get permission from the irrevocable beneficiary, because that also affects the death benefit and everything at the other end. Of course, taking a policy loan, you have to get permission from that, because once again, taking out a policy loan affects the value of the policy as well. And so therefore, you can see that when you do name the irrevocable beneficiary, you really tie up your hands a lot. But the one thing you do not have to worry about is, of course, changing the premium payments and everything else. That's perfectly fine. And that is extensively discussed, actually. Question of revocable and all that stuff there is extensively covered in Chapter 2. Okay, Chapter 2, 1.4, Section 1.4 talks about this particular subject matter as well. Okay? Draw your attention, by the way, and some of these questions always have the words not or cannot and all that sort of stuff there. So please make sure you read the questions very carefully to reflect that. Okay, question 9, and we've got Orlando. Okay, so Orlando is an insurance agent who wants to ascertain the identity of his client, Juan. So Juan produces photocopies of his driver's license and a photocopy of the Canadian passport. He also produces a credit card bearing his name. Can Orlando ascertain the identity of the client based on documents produced? And the simple answer really is no. Because when you're trying to ascertain somebody's identity, you need the originals. Okay, not copies. You must have the original. So the original driver's license or passport is required, right, basically. Right? And so therefore, you can make a copy of it. That's fine. But you, as the agent, saw the original, so you can attest in a court or whatever that yes, I did see the original, and you can prove that it's original, and so on and so forth. Okay. But a person walks into your office and gives you a copy of the license, or gives you a copy of their passport, or a copy of any kind of identity papers and everything else, it will simply not be acceptable. You have to provide the original. Now, the credit card is not acceptable because credit cards don't have a picture. So therefore, credit cards, generally speaking, are not acceptable. There is the odd exception, but for the most part, the answer is no. Okay. So if you have a birth certificate, you've got a passport, you've got a driver's license, a landed immigrant status, things of that nature there. All of those have to be the original amount. Otherwise, they would simply not be acceptable. And that is extensively discussed on Chapter 4 and it's Section 4.1. So Chapter 4, Section 4.1, they talk about what is needed to identify an individual. So as I said, it is the original birth certificate, driver's license, passport, permanent resident card, certificate of Indian status, and so on. But all of these things here have to be landed immigrant status, for example. All of those things are available, but they have to be the original. No actual copies or anything. So let's go on to Jerry and this question number 10. So Jerry is receiving a pension from a pension annuity that has guaranteed period. His wife Susan is alive, and according to the terms of the pension plan, on Jerry's death, his decision to receive a reduced pension, and Jerry's names his son John as the beneficiary of the pension annuity. So assuming that Jerry dies before the guaranteed period, the contract is over, and Susan and John are both alive, okay, who will receive the annuity payments, okay? So under the law, what happens is that the priority is always given to the spouse. So if you have any kind of a pension with a guaranteed period or whatever, okay, under the law, the spouse is always before the beneficiary in this case. So in this case here, Susan is the one that will actually receive a reduced pension once in this case, once Jerry dies, okay. If there was no Susan, in other words, if there was no benefit, no spouse, then the son, John, would have received the money. They would simply commute the amount of money and give a lump sum, let's say, to John. They would give him a monthly income or anything. The monthly income is only for the spouse. But in this case here, there was a spouse, and so therefore the spouse supersedes the beneficiary. Now, if by chance Susan should in fact die during the guaranteed period, then once again, Jerry will receive the cumulative value for whatever money is left over in the pot, okay? But that is after Susan dies. But in this case here, only Jerry dies. Susan, who's the mother, or spouse in this case, still very much alive. So therefore, she becomes basically the successor on a reduced basis, but he doesn't become the successor to the annuity. And then again, if Susan should die within that guaranteed period, if there is some money left over, then John son will receive the cumulative value of that pension. Okay, so that's why in this case here, the answer is Susan will in fact get the money. So this is discussed in Chapter 3 and in Section 3.8. So Chapter 3, Section 3.8 talks about successor annuitants and everything else when it comes to pension plans and everything. Okay, let's go to number 11, and we've got Nevin. So once again, I'll give you a moment to read this. Okay. Okay, so Nevin owns a permanent life insurance policy on his life. The policy is a cash surrender value of $200,000 and an adjusted cost base of $100,000. He decides to take a loan of $150,000. He is told that he will have to include $50,000 taxable policy gains in his income this year and pay tax. What type of loan did Nevin take? So before I answer that, remember that there's two ways of getting a loan from an insurance policy. You can either be a policy loan or it can be a collateral loan. Okay, so in this case here, he actually borrowed money right from the insurance company itself. So therefore, it is a policy loan. Okay, and because it's a policy loan, then there will be a disposition. Remember, under the law, okay, the rules of the game basically is that if you withdraw money or you borrow money from the insurance company, okay, then there is considered a disposition. So the difference between the ACV, in this case here is $100,000, and the $150,000, which he actually took out, that $50,000 represents a gain. So even though it's not actually a withdrawal, but just a loan, that $50,000 is still considered a disposition, and therefore he is going to have to report that as a policy gain, and therefore pay his taxes. On the other hand, if he went to the bank with this very same policy, and the bank actually gave him a loan of $150,000, that would be considered a collateral loan. And in a collateral loan, there is no taxation, because he never actually touched the policy. All he did is collateralize the policy. So the policy is still owned by him. So there's no disposition, there's no transfer of ownership, no change of beneficiary. None of that stuff has happened. All he's done is put a lien against the policy. So as a result, in a collateral loan situation from the bank, there is no lien disposition, and therefore, as a result, there is no taxation. So you will usually get a question on the exam in regards to the difference between policy loan and collateral loans. Policy loan, there is a disposition, and you may have to pay tax on the gain. In a collateral loan, there is no disposition, and therefore, the money comes to you on a tax-free basis. Okay, and that is discussed in Chapter 2. Okay, Chapter 2, Section 6.1 is where we touch on that particular subject. Okay, let's go on to 12, and we've got Yasmin. So Yasmin is studying for life licensing qualification program, okay, which is obviously what you're studying for as well, okay, and she wants to become a life insurance agent as soon as possible. She is curious about the difference between the Llqp programs she can complete in order to obtain a license. She has heard of the following types of programs. What she's heard about is that there's licensures for all of these, okay, full Llqp, Llqp accident sickness, group representative, annuity sales representative. So you tell Yasmin that her options are, okay, in reality, there are no 4 licenses, really only 2. In other words, you can get your full Llqp, or you can get simply an accident sickness Llqp. So if your intention is only to sell travel insurance, let's say, or to just sell living benefit products, not life insurance, not pensions, no segregated funds, no annuities, no group pensions, none of that stuff there, then you don't really need the full Llqp, because the living benefit section, which is the accident sickness portion module, that's all you really need to take. Okay, you just simply get an accident sickness license, and you now can sell travel insurance, like I said, living benefit products, also critical illness, long-term care, disability insurance, group insurance, all that kind of stuff there can be sold under the accident sickness license. But you cannot sell any pension plans. You cannot sell life insurance. You cannot sell RSPs, RIFs, group annuities, anything along that line. In order to do that, you have to be the full Llqp. And so there's no such thing as a group representative license or an annuity sales representative license. Okay, those are all under the full Llqp basics. So you get the full Llqp, you can sell group life, you can sell annuities, you can sell basic world. Okay, but so the only two licenses we have now in Canada are full Llqp and a Llqp for accident and sickness only. Okay, and that is extensively discussed on Chapter 4. Chapter 4, Section 3.2. So Chapter 4, Section 3.2 talks about the different kinds of licenses that you can actually get. Okay, and let's go on to 13, and we've got read up. Okay. Of the following, Rita wants to know which of her properties and assets will pass through her estate. Home held in joint tenancy with her husband Tom, life insurance policy on her life, naming her daughter as the beneficiary, her registered retirement savings plan, of which she is not named the beneficiary, a tax-free savings account naming her husband Tom as the beneficiary. Okay. What do you tell her with those? Remember, these are what she wants to know is Rita wants to know which of the properties and assets will pass through her estate. Okay, and you'll see there that 3 is the only one. And why is that? Okay, because remember the RRSP, she has no named beneficiary. So when you don't have a beneficiary, the ultimate beneficiary is always the estate. So therefore, the default beneficiary is always the estate. Had he first actually, this person, Rita, actually named the beneficiary, say Tom in this case, as her beneficiary, then it would have bypassed the estate as well. So in this case here, the house held in joint tenancy automatically, the moment she passes away, her husband automatically steps into her shoes. So this is what they call a spousal rollover. The life insurance policy, of course, because again, names her daughter as a beneficiary, so there is a beneficiary. That also bypasses the estate. The TFSA named Tom, her husband, as the beneficiary. That will also bypass the beneficiary. So moral of the story is that if you have a named beneficiary, then it bypasses the estate. If you do not have a beneficiary, then the monies will aid in the estate, in which case then will be subject to creditors attacking it, and taxation and all those things there. So we usually recommend, of course, to not name your estate if at all possible. Always have a named beneficiary. It will certainly be better from a tax perspective, ownership, creditor protection, all those kind of things there. And so that's why it's C. This is discussed in Chapter 1. So Chapter 1, Section 2.7. Basically, we'll discuss this particular topic. And we've got Yolanda, question number 14. Okay, so what we've got here is Yolanda wants to know the components, the principle of acting in good faith. Which of the following is a component of acting in good faith? And remember that this is a situation where you're supposed to be prioritizing, obviously, your clients and so on and so forth. Okay, so when you're acting in good faith, what you're really doing is the duty of care. Okay, you have a duty of care to prioritize your clients' interests first. So in acting in good faith, what you're really saying is, I care. Okay, I care for my client. I put them before I put anybody else, before myself or anybody else. So my personal interest, or number 2 or number 3, the number 1 interest is making sure that my clients are well taken care of. Okay, so like I said, priority is always the client. So acting in good faith is duty of care. Remember, also under acting in good faith, you've also got integrity, which I know is not listed on there, but you should be aware that under acting in good faith, it needs integrity, which means act honestly, respectfully. When you say you're going to do something, do it. That kind of stuff. There, act honestly, respectfully, things of that nature, basically. And of course, the other one is competence. Make sure that you keep up with what's going on in the marketplace, what's going on in your products. In other words, knowledge base. So what you're doing right now, for example, can be referred to as competence. But what you're doing is learning about these products and everything else. So that way you can explain to your client. So competence basically is keeping up with the education part of your career and everything else. So once you get your license, not the end, and actually that's very much the beginning, because from then on, you're going to have to take a number of courses, meetings, and things of that nature there to keep up with what's going on in the insurer world and everything else. So that is all part of the absence of good faith. But the priority of absence of good faith, the very first thing, is duty of care. The other ones are, like I said, integrity and competence. And that is discussed quite extensively in Chapter 4, 4.2. Strongly recommend you review Chapter 4, because that is really all about you. And you're going to get a number of questions about you, how you should be conducting yourself in the presence of the client, in regards to your clients and so on and so forth. So I really recommend that pay particular attention to Chapter 4. Because, like I said, it is rather important to do that. Okay, so this is all discussed in Chapter 4, Section 4.2, where you'll learn all about duty of care and, of course, a whole bunch of other things as well. So let's go to 15, and we've got Diana. Okay, so Deanna is a new life insurance agent and wants to know which of these products are not, okay, the word not exempt from requirements for ascertaining the client's identity under the Proceeds of Crime, Money Laundering, and Terrorist Financing and Financial Transaction and Reporting Analysis Center. In other words, reporting to FINTRAC, okay, guideline number 6A, as they call it. So these are products that, so which one of these four products basically do you not have to report? So a person comes in and buys these particular products, which ones are the ones that are not exempt? In other words, you do have to report to FINTRAC. If a person walks into your office and buys and puts on your desk, let's say more than $10,000 or more, which one of these are not exempt products? Okay, and they are, of course, the 1 and 2. Immediate annuities and deferred annuities. Okay, these are what we refer the products that are not exempt. So if a person walks in and wants to buy an immediate annuity or wants to buy a deferred annuity, and that could be a segregated fund, it could be GIC, it could be any of these kind of things there, but they're not registered money. Okay, they're not exempt registered money. So therefore, if they are not registered immediate annuity and non-registered deferred annuity, then you must report. If a client walks in and puts in more than $10,000 and you suspect that there might be an issue with money laundering or terrorist activity financing and all that, then you have a legal responsibility to report that, and you must report that to FINTRAC within 30 days of the client walking into your office. 3 and 4, you do not have to report. So in other words, an exempt life insurance policy, if you remember, that's a policy whereby the money that's in the policy is tax sheltered and everything. The person buys an exempt life insurance policy like Universal Life and Whole Life. These are all exempt products. You do not have to report. So even if the person walks in with $100,000, you don't have to report if it's an exempt product. It's only when it's not exempt. The tax-free savings account, again, is also an exempt product because it's also, so essentially any kind of tax-sheltered product, such as exempt life insurance, TFSAs, RSPs, RIFs, LIFs, LIRAs, any basic registered money, in other words, any tax-exempt product is considered exempt. And therefore you do not have to do any kind of reporting whatsoever. But if you buy a non-registered plan, such as, like I said, immediate annuity, a deferred annuity, then you do, and he does give you $10,000 or more, then you must report that to FINTRAC if you suspect that there might be a money laundering issue and everything else. Okay, so just to remember, the exempt products are exempt life insurance, like RSPs, RIFs, LIRAs, LIFs, DPSPs, RPPs, TFSAs. Those are all tax sheltered vehicles, and as a result, you do not have to report that. But if it's not registered money, so non-registered segregated fund, immediate annuity, deferred annuity, then you do have to report that if the client is giving you $10,000 or more. And this, once again, is discussed in Chapter 4. As I stressed to you moments ago, but please make sure you read over Chapter 4. Now, there's a lot of stuff in there that you're going to be tested on and everything else. So Chapter 4 and Section 4.1 will give you the information. that you need for this particular topic. And I can assure you, you can bet your last dollar, you will definitely get a question on money laundering and FinTrack, things of that nature there, because it is a serious issue. Okay. 16, we've got Tina. So I'll give you a moment. So this question is a preferred beneficiary type of question. So Tina owns a permanent life insurance policy with accumulated cash value and is interested in naming a preferred beneficiary to her policy. So Tina suggests naming her spouse, child, parent, or sibling as a preferred beneficiary. Which individual will not be considered as a preferred beneficiary? Okay, and the one that's not going to be considered is a sibling. Remember that a preferred beneficiary, the reason why we designate, classify people into preferred and not preferred, is the preferred beneficiaries are basically the monies that you leave them are creditor proof. In other words, they're free from seizure. So if your estate owes a whole pile of money and everything else, and creditors are seizing your estate, they cannot go after the money that you left your spouse or your child. So the preferred beneficiary basically is your mother, your father, your spouse, your children, your grandchildren, and adopted children, legally adopted children. So if you notice, I didn't say sibling. Okay, so in other words, I leave the money to your sister, your brother, your uncle, the ones outside of that. So sister, brother, uncle, cousins, all that sort of stuff there, they are not protected against seizure. Okay, from the estate. So creditors could go after that money. So if you leave $100,000, say, to your brother, but yet your estate is in debt, basically, the creditors could in fact go after your brother for that $100,000. But you leave the same $100,000 to your son, that is a preferred beneficiary, or to your spouse or to your parents, that is a preferred beneficiary, and therefore they cannot chase after that money. So it is very important to understand the difference between these things here. And that is discussed in Chapter 2, Section 2.1. Talks about preferred and not preferred. So the not preferred, of course, you can go after them. So like I said, your brothers, your sisters, your cousins, uncles, and all that, those are what we call not preferred. And therefore, the creditors of the estate could in fact go after those people if you leave the life insurance money to them. But if you leave it to your preferred beneficiaries, such as your spouse, your children, your parents, then there's no issue there whatsoever. They are protected against seizure. So go to Chapter 2 in the Section 2.1. We'll discuss that particular section. And again, that's a very important section, so strongly recommend you spend some time reading that Chapter 2. Okay. So let's go to question 17, and we've got Terry Owens. So Terry owns the following assets. He owns a very short-term savings plan account, which names his son as the beneficiary. So he owns an RSP, and he's got his son as beneficiary. He also owns a life insurance policy on his life and names his daughter as the beneficiary. He also has a non-registered mutual fund account that names his son as the beneficiary. Okay? And he also names a non-registered segregated fund account that names his daughter as a beneficiary. Terry wants to know which of the following accounts could be seized by the bankruptcy trustee should he declare himself bankrupt. What do you tell him? Okay. So again, it's a similarity to the previous question in that there are certain people that will be protected, certain products that will be protected, and certain products and people will not be protected. In this case here, who's not going to be protected is the number 3, which is the non-registered mutual fund account. So when you have an RRSP, the fact that you have a named beneficiary, in this case your son, so there's your preferred beneficiary, I was saying, son is their preferred beneficiary, that person will be protected against creditor seizure and everything else. Again, the life insurance policy, you leave your daughter, there's a preferred beneficiary again, you see, and so therefore, once again, the money will be protected. The non-registered segregated fund account, again, the daughter is the beneficiary, but again, that's a preferred beneficiary. So therefore, those 3 particular areas, they cannot seize the money on that because you have left the money to a preferred beneficiary, okay? Now, you might say, well, wait a minute, now, the mutual fund, they also have preferred beneficiary. unfortunately, mutual funds do not fall under the Creditor Protection Act. Okay, they are outside of that act. And so as a result, any amounts of money that you have in a mutual fund could be seized regardless of who the beneficiary is going to be. Okay, so in the mutual fund situation, basically, because this is non-registered, if it was registered, then the answer would be that they would be protected because registered money is always protected. Okay, but in this case here, it was non-registered money. So the end result of that is that even though you have a named beneficiary as being a preferred beneficiary, but because it is a non-registered mutual fund, it is not protected under the Bankruptcy Act, and therefore, if you have $100,000, let's say, sitting in your mutual funds, and you have $100,000 sitting in segregated funds, the segregated fund, and they're both non-registered, the segregated fund will be protected because it falls under the Insurance Act, but the non-registered mutual fund, because it falls under the Securities Act, then that money is not protected. And that's one of the reasons why sometimes self-employed people, for example, tend to buy segregated funds because they like that creditor protection aspect, the bankruptcy protection aspect, which is not afforded to them when they put the same amount of money into a mutual fund. Okay? So I urge you to read Chapter 1, and it's discussing Section 1.2.9. Okay, this discusses what is creditor proof and what is not creditor proof and things of that nature here. But in this case here, it's an unregistered mutual fund, which will be not creditor proof. And let's go to 18, and we've got Carla. So this is a question of deceptive practices. So we go back to Chapter 4. So as I said before, please make sure you read over Chapter 4. Okay. So Carla offers her client Janice a rich retirement plan loan for which she qualifies. The loan is normally offered at the prime rate based upon Janice's financial standing. Carla tells, however, Janice that she can only offer the loan if she agrees to transfer her RSP to a financial institution. So what deceptive practice is Carla guilty of in this case here? And that is, of course, tight selling. You cannot make the sale of one financial product conditional on the client buying another financial product. And that's what she's doing here. She's basically saying, yes, I'll give you the RSP loan, but I want you to transfer your RSP obviously to our financial institution. You cannot do that, okay? You cannot make the sale of one financial product conditional on buying another financial product. That would be tight selling. So that is a deceptive practice. It's not churning, because churning, if you remember, is when you're canceling an insurance policy with this and replacing with the same insurance company. Okay, so if you're canceling, churning is basically when you are canceling an insurance policy and then at the same time issuing a new policy with the same insurance company. Twisting is when you cancel an insurance policy but you're offering a new policy with a different insurance company. So twisting is sort of external, you might say, that it's with a different insurance company. Churning is within the same insurance company. So in this case here, even though it does fall under deceptive practice, it doesn't fit the question, basically, but still is a deceptive practice, okay? Of course, trafficking insurance is a deceptive practice in that you're not allowed to buy a life insurance policy that's already in force. In other words, you can't go to your clients and say, okay, you've got a $100,000 policy, and I know you've got financial issues and everything else. You're not well, you're not healthy, all that sort of thing. I'll tell you what, I'll buy you the insurance policy from you. So here's a check for $10,000, and transfer ownership of that policy over to me. Obviously, once the transfer is made to you in an absolute transfer, then you're going to go off and change the beneficiary to yourself. And then when the client dies, of course, you get the money. That is illegal. Okay, so trafficking in insurance, again, is a deceptive practice. You're not really acting in the best interest of your client. You're really acting more in your own best interest more than anything else. And you're also speculating. And in the insurance industry, you're not allowed to speculate on another person's life, basically, as well. So you have to take a look at that. So in the context of this question, it is tight selling, is the deceptive practice. And that is discussed in Chapter 4, like I said, in Section 4.2. Discusses. So please read over Chapter 4, because there are many questions on the exam that will come from Chapter 4. Let's go on to number 19, and we've got Valerie. Okay, Valerie. Okay, so Valerie is a new insurance agent who's confused about the roles of various regulatory authorities. She wants to know which agency is responsible for regulating agents and insurance agencies, because the agents and insurance agencies. What does Valerie's supervisor tell her? And it is provincial and territorial insurance regulators. So who regulates you is your province, basically, okay, and the agency that you may represent and all that stuff. It's your province. So, for example, in the province of Ontario, it's fiscal, the Financial Service Commission of Ontario, okay. In Quebec, it's AMF, okay. In Nova Scotia, it's Nova Scotia Superintendent of Insurance. So each province, we have, of course, 10 provinces and 3 territories. So we basically have 10 provincial regulators and 3 territorial regulators. And these are the ones that regulate you as an agent, they regulate your companies, an agent, your insurance agency, regulates an MGA, things of that nature there. CCIR is the Canadian Council of Insurance Regulators, and that is, of course, it regulates the insurance industry itself. So it's basically an interprovincial jurisdictional organization, okay, that basically regulates to create some kind of harmony between the provinces in terms of regulating the insurance industry itself. In other words, it regulates the manufacturers. Okay, so basically, OSFI, of course, is the Office of Superintendent of an Institution, and that's a federal officer, and that is, if you remember, this is regarding solvency. So OSFI is responsible to make sure that the company in question here is solvent. They're able to make the liability to pay their bills, basically, and pay the claims when claims come due and everything else. So OSFI is a federal organization that is responsible for regulating solvency, making sure that you're able to pay your claims. CISRO is the Canadian Institute of Supplies and Regulatory Organization. Basically, all that is it regulates the training material. So the book that you've got in front of you, okay, the material that you've been looking at for the last little while, the 5 books that you receive from your provider or the 5 modules, whatever, those are all CISRO. And CISRO basically is the organization that regulates the standardization, educating you as an agent. And so once again, it's across the country. CISRO governs all the training that happens from coast to coast. That way, once again, you get consistent training, consistent basically material and everything else. So there's no misunderstanding. You've got to remember that today, of course, we have a very mobile society. So you might have bought an insurance policy in Nova Scotia, but you end up retiring in Victoria, and you carry, of course, your policies with you. So you have to have some kind of consistency here, so that whoever's taking care of your affairs now in Victoria understands the rules, because the rules are the same right across Canada and everything. Okay, so the one that's in terms of regulating you as an agent is the provinces and the territories. All the other ones are basically national organization, and they do not regulate you. Okay, they regulate the industry, largely in training material, basically. And that is covered on Chapter 4 in Section 4.1. So Chapter 4, Section 4.1 is where you get all of these government organizations, and you'll see them all listed there as to what they do and what they don't do, and all that sort of thing there. And now we are down to our last question of the evening, which is question number 20, and we've got Marty. And again, I'll give you a moment to read that. Okay, so Marty is a member of registered pension plan provided by his employer. He has over $400,000 accumulated in his pension account. Marty dies in a car accident while driving to work. He is survived by his spouse, Della, and son, George. Marty had named his son to be the beneficiary of his pension fund. who will receive the benefit of pension plan and how will it be dispersed, okay? So this is very similar to a question that we had before, where we were basically saying is that if there is a pension plan and there is a spouse involved, and the spouse, in actual fact, takes priority, okay? So on the death of the pension member, okay, if there's a spouse involved, then the spouse will, in fact, have priority over the beneficiary. So in this case here, Della, who may roll into a locked-in plan, is the correct answer. Remember that money sitting in a company pension plan is locked-in money. So basically what can happen here is that the spouse, in this case Della, will simply roll that money into her own locked-in plan. Remember, the word locked-in basically means it's designed to pay an income to Della for the rest of her life. So it could be a reduced pension, whatever, that's not the issue. But the point is, even though there is a beneficiary, so your natural inclination is to say, okay, well, son George is the beneficiary, okay, so I guess he gets the money. No. Under the Pension Act, if there is a spouse, the spouse takes precedence over the son, over basically in this case here. Okay. Now, should something happen if there was no spouse, then yes, you're quite correct. George would have received the money, what they call the accumulated, basically present value, and it's the cumulative total, and he would have received the monies. Okay. But in this case here, his mother is still alive. At the same time, if once the money starts coming out, in other words, the income, and Della starts getting an income, should she pass away, and there's still money left over in other words, within the guarantee period or whatever, then it's quite possible George will receive something at the other end. Once again, he will see the cumulative value of the fund and everything else. But because there is a spouse, and the spouse takes precedent over the child, basically, that's really the moral of the story, is that the spouse takes precedent over the child. And so this is discussed in Chapter 3. Okay, Chapter 3 and Section 3.8 is where we discuss the various different pension plans and everything else. Okay. So as I said at the beginning of this lecture, this particular section, of course, is the shortest of all the three different modules and everything else. As you can see, we took just a little over an hour to finish off this particular section. Okay. So, but again, don't take it too lightly, because it is again a very important part of your exam. But nonetheless, that finishes basically the lecture for this evening. And so you're basically now ready, if you want, to write the certification exam. And I always stress that you should write the certification very, very shortly after we finish these lectures, because this stuff is still fresh in your mind, basically. So what I would recommend, is read over the material, go over the material that we just talked about, and then as quickly as possible, please write the certification exam, because it's fresh in your mind. You have a better chance of